we have these concepts called master budgets, right? So the master budget is a budget that includes everything from a finance perspective. So we'd have our sales, and this is how we have the order we have to prepare it to. And so you have to memorize this order. We have our sales, our production budget. Our production budget will go into our direct materials, direct labor, and factory overhead budget, which then goes into our cash budget. After we finish our sales, we can also create a capital expenditure budget and a selling and administrative expense budget. All of these will feed into our cash budget, which we do as a last budget before our budgeted financial statements. And then we'll make future looking balance sheet, income statement, statement of cash flows for all the period. Those are pro forma statements. They're looking into the future. And it's really like your FP&A financial advisory kind of role, or financial analyst kind of role. And so they're saying here, they're breaking it out into a few different components. These are everything in lighter orange here: sales, production, all these. And here are operating budgets. We have capital expenditures is an investing budget. What are we going to invest in? And our cash is our financing budget. And the idea here, just to work through it, I know it seems like a simple chart, but I want to make sure there's a lot here that would really help you. Why do we need to do our sales budget first? Well, I don't know how much I need to make until I know how much I expect to sell, right? If I'm going to sell 100 bicycles, then I know how many I need to produce, at least 100 bicycles. But if I don't estimate the sales first, I don't know how much to produce. If I don't know I need to make 1,000 bicycles, I don't know how many pieces of machinery I have to buy, or warehouses I have to buy or lease. And I don't know how much marketing expense I need. So sales always starts it. And after our sales, we can figure out if we need to build warehouses, buy or lease office space, or buy equipment. We can figure out if we need to hire more salespeople to hit our sales targets, or marketing people. And then once we get our production budget down, how much we need to produce in order to make our sales, then we can determine how much materials we need, how much labor we need, how much overhead we expect to incur. And then only after all of these pieces can we actually make a cash budget. And then once we have all of these pieces in a cash budget, then we can make our financial statements, because cash is a component of our financial statements. Sales is a component of our financial statements, and so on and so forth. Okay, so let's prepare the operating budget for a master budget for a manufacturing company. What's the operating budgets? It's everything over here that we talked about, this big chunk, the most complex part of it. Sales, production, direct materials, direct labor, factory overhead, and the selling expenses. Sales budget. The first step in preparing the master budget is a sales budget, which shows the planned sales, units, and expected dollars for those sales. The estimated units. So what we're doing here is we're going to take the estimated unit sales and the estimated unit price. Why are these estimates? Because we're looking into the future. We don't know. We really don't know when and what we are going to sell. We're going to estimate based off on historic measures. The coronavirus is a good example of where budgets can go off. Everyone was expecting to have a really good Q1 this year, a really good Q2. But when coronavirus came, the budgets got blown out of water because you can't estimate for something like that, right? And so we always estimate historically. So just know that these are estimates. Estimate unit sales and the price. And what we have to do is take an analysis of the economic conditions, the marketplace, and as well as our business activity. But you'll be given all of that information, right? I'm just saying in real life, you'll have to estimate. But we'll be giving you the dollar amounts. We'll be giving you the budgeted sales. And you'll just have to determine the total budgeted sales dollars. So relatively simple here. You have the budgeted sales. You'll get 1,000 in October, 800 November, 1,400 December, and then a total. And then your selling price per unit, we're saying is probably going to stay constant here at $60. Just multiply it out, and that's your estimated sales per month, and this is your estimated sales per quarter. We take these sales to make a production budget. The production budget is the manufacturer prepares this in order to make sure that they can create enough units. So units to produce is equal to the ending inventory plus budgeted sales minus beginning finished goods inventory. And now that I've seen a lot of people get confused about this, it's pretty simple, right? Whatever we have to make, if we have stuff we already started with, we don't have to make it. We can just sell it. It's from the past. Plus anything that we expect to sell, we should include that into our units that we have to make. And then less anything that we want to end with. So if we want something called a safety stock or a margin of safety, we want 10% of our units to be in our warehouse just in case we oversell, then we have to add that to the units to produce, or beginning finished goods. And budget and ending inventory here is what we want to add in, and the finished good inventory is what we want to subtract, the beginning finished good inventory. So the beginning finished good inventory, what I was saying at the beginning, whatever we had at the beginning of our inventory, we want to make sure that we remove it. I was just circling the wrong box. But anything that we want at the end for our margin of safety, we have to add it in. And so this is where you'll see it. The most complex piece here is just making sure you roll forward the previous month. Otherwise, it makes a lot of sense. So they're saying here, next month budgeted sales. We got this from our first budget, right? The sales budget. And then ratio of inventory to future sales. We want to keep 90% for our ending inventory. That's what they're saying. So they want to make sure that we have this in a margin of safety rolling forward. So budgeted ending inventory, we want 720 units. Add budgeted sales. We expect 1,000 sales here in units. And so our 720 plus our 1,000 equals our required units to make production. But we're going to deduct our 1,010 beginning inventory to get our 710 units we have to produce. Then we take our 1,400 up here, 1,400, if we go back, that's this 1,400 in December, times our 90%, that gets our budgeted ending inventory again. Budgeted sales is 800, we got here, right? The 800 gets pulled over. That combined equals our 2,060, and then we move our budgeted ending inventory to our beginning, which is our 720. And that 720 gets subtracted out of it, right? Because we already have that in our inventory. We only have to produce 1,340. We do it again here, 900 times the 90%, right? The 900 again isn't here. The 900 we're going to say is the January amount that we're estimating. The 900 times 90%. So you'd be given this 900 amount from sales budget. January budgeted sales is 900 units. 900 times 90%, that's our 810. Our 810, then we take the 1,400 from November as our budgeted ending inventory, and then we add the required units. We add these two together, get our required units available for production, subtract out our beginning inventory, and to get our 950. So that's just the production budget. Just understand the flow. Just understand the flow of information. You should be all right. Understand how the 720, the ending inventory flows to the next month, the beginning inventory flows, or the sales flows to the beginning inventory. Then the direct material budget is going to be derived from the production budget, right? So we know how much we need to produce. So just copying this over, 710. We know we need to produce 710. So they're saying we need 0.5 materials for every unit. So in October, then we need 355 materials or pounds of material. At 355 pounds of material, we're going to add whatever was of our material was in our ending inventory to get our total material requirements, 690 what we want in our ending inventory, and then whatever's in our beginning, we're going to subtract, and we're going to get, we need to purchase 512 units. The 512 units is at $20 a pound, so our cost of direct materials is 10,240, and so on and so forth. The 1,340, we got it from here, 1,340, multiply the 50%, we get our 670. The 670 is, then we add the budgeted ending inventory, the 237.5, at that ending inventory, plus the 670 is going to be our 907.5, and then we subtract out, right, we roll forward this 335 down over here again, and then that's how we get our 572 and multiply out our cost for direct materials. So you can see relatively simple. We just flow through the information, really simple math. We just have to make sure we keep everything organized. That's really what a budget is. It's keeping everything organized to forecast. And so it'll just take you some time to get used to those flows. All of these are estimates based off normally historical truths.